Good morning, everyone. Thank you so much for joining us today in this conversation on how 2024 is going to be the year for fixed income investing. One of the things that we uh, started to look at is that 2024 actually gives us a lot of opportunities because today, if we look at where the equity markets are, you're seeing some visible cracks, and it's only the beginning of what is to come. If we look at other safe asset classes like gold, you've seen significant performance come in the last couple of weeks. So the question really comes to where can investors turn if they're looking for safety? And when we look at that, I think you will realize that today the conversation that we want to have is that about the four different kinds of investors who really need to look at allocating to fixed income today, right? So one thing is that if you relate to any of these statements, that is, if you've made most of your returns from small and mid caps, if you have short term financial commitments or commitments coming up in the next year, 2 or even 3 years, right? And if you consider yourself a conservative investor, or your investing experience is limited only to the last 3 years or 3 or 4 years in the market, I think this is a great time to look at fixed income. And let me explain why this is true, right? Because if we've made most of our returns in small and mid cap funds in the last 5 years, where they've done exceedingly well, we need to be mentally prepared that the next 5 years are actually going to be very different for investors. So you've made more than your fair share or expected returns in a shorter time frame, which means that there will be another period where you return to like a mean sort of level of returns. So we have to be prepared for the new normal in that space. When it comes to short term financial commitments, I think today more than ever before, we're a little bit more uncertain about how markets are going to perform and what asset classes are going to be able to help us fulfill our obligations. So, if we're in that mind space, then we are going to be seeking predictability. We are going to look at options where there's more a level of mental comfort and peace in our investment decisions. Now, the third thing is that many of us don't really know what our true risk appetites are because we've started either a few years ago and we've had a very brief or one dimensional sort of understanding of how markets work because you've seen quarter on quarters companies doing better and better, whatever targets are there. You've seen that they've been able to comfortably achieve that. You've gone from a period of very high inflation to lower, steady inflation, like inflation generally coming down. And we've had lower interest rates and we've moved into a higher interest rate scenario as well. So, with all of this in play, a lot of investors have actually unconsciously ventured out of their comfort zone, right? Of safer investments. Maybe 6, 7 years ago, if we talked to investors and told them to start SIPs, there were a lot of questions that would come in about whether this is a safe enough investment, right? Today, nobody is really talking about safety. The dialogue has completely changed. But many of us are inherently conservative investors. We don't like to worry about our investments when we go to bed at night. And if we're in that space, we're going to rediscover what our true risk appetites are. And before we're given a rude shock, it would make sense to sort of allocate to an asset class that can help you stay within your comfort zone when there's so much turbulence and uncertainty around you. So that brings us to the question, right? So if I'm not such an aggressive investor and if I'm really going to want to explore what my risk appetite is, if I want to stay invested in equity, should I really be looking at fixed income now? Right? And the thing is that you don't need to look at this as an either or situation. Uh, Harshini, you can change the slide. Yeah, because it's not an either equity or fixed income moment. I think today the opportunity is such that you can have um, choices in both asset classes. The key thing that we need to keep in mind is that Right now the opportunity is in fixed income. There will be plenty to come in equity in some time. So even if you're an aggressive investor, I think it makes sense to do some level of profit booking, some level of portfolio restructuring, and temporarily allocate to fixed income today. And then when you're spoiled for choice to come back into equity, you don't need to force yourself to make that decision today. You do have certain parts of the equity market that are still very attractively valued that you can allocate to. But by and large, broadly, fixed income as an asset class is giving you so many opportunities. And let's look at some of those opportunities, or why today that chance is so rich. Because we need to understand that the combined forces of structural and cyclical factors are acting in favor of fixed income. And what do I mean by that? If we look at some structural forces, right? So you have your current account deficit where you're heading to a new normal. So if we look at our trade and our balance sheet, like our external balance sheet, you will notice that we are no longer just a services export country, right? Harsini has actually written a blog on manufacturing. You can go and read that on our website. We can look at all the schemes that have come in the last year or so, not just the last year, but like for some time, we've been developing this whole thing of Make in India. We've been developing a lot of public linked incentive schemes. All of this has come in primarily because uh, you are now looking at a more broad-based growth coming from different sectors of the economy. There's no concentration in one or two sectors. And because this growth is there and we're able to develop these trade agreements with partners across the globe, your CAD is coming down. Your reliance on oil as a form of energy, as a part of your total GDP, has come down. And we've also seen the government, despite COVID and all of that, uh, following this path of fiscal consolidation, right? Where they've consistently been saying that let's reduce the fiscal deficit, let's rely more on what we already have rather than constantly expanding the balance sheet. So these are the structural factors, and these are long-term trends that are really going to be with us and help us sort of navigate where interest rates will be in the future. But on the cyclical side, also things are kicking into our favor, right? These structural changes have been happening for the better part of the last 5, 6 years. But your cyclical factors are really coming into play only in 2023, 2024, and probably in the coming year as well, which is that we are at peak interest rates. The way central bankers are talking, whether it is the Fed or whether it is the RBI, you're not really looking at a lot of rate hikes from here, because inflation is under control. Growth has not yet really slowed down, and then you have other factors that have been at play. So when you come to all of this together, you realize that you're actually at the opportune moment. Your opportunity in fixed income is really, really fantastic today, because you have high interest rates, you have controlled inflation, you can have a sustained period of good returns from fixed income. And let's look at what the governor from the RBI is also saying. He's talking about how growth is accelerating and outpacing most forecasts. So if you go and look at the last 1 year data, what was the actual growth number was, or what was the projected growth number versus what is the actual growth number? All the revisions have actually been upwards, right? And if we look at the kind of progress we've made from 2021, 2022 in terms of where inflation was at that point and where we are today, you've seen a consistent sort of downward trajectory, right? And if we also look or spend a little bit of time in understanding what the RBI has been doing, because there have been many items in the news over the last month or so where you've seen first some regulatory action on Paytm, you've seen it on a couple of other NBFCs, and now you're seeing that the RBI is not actually waiting for a issue to occur and materialize and precipitate before they take action, right? They are proactively sort of addressing issues that could crop up before they become widespread or before there's enough panic uh, to be caused. So that's actually a very good approach to managing any kind of regulatory risk, because this ensures that one, that problems are addressed in their early phases rather than much later, because once you allow a problem to fester, it becomes harder to contain, or it requires very aggressive combating techniques, right? But this is not true of only the Fed, only the RBI. I think you'll see even on the Fed side, the commentary is about how you're heading towards a rate cut cycle, primarily because inflation has come under control for the Fed, or it is showing signs of being under control. So one thing is that last year, you had the Fed sort of become slightly dovish in the December policy, where they kind of said that this year there will be rate cuts, and the markets were expecting it to happen as early as this month. And then you realize that probably based on certain other things and what the governor has been, the Fed chair has been talking about, that it's not going to happen as early as people expected, but it is likely to happen, right? They want to see good data, and by good data, they mean inflation coming under control. One of the things that has really pushed gold prices up is the fact that unemployment numbers came out looking higher than they usually did, right? So it had been around 3.4, 3.5%, and now you're at 3.9%, and that's a significant jump. So I think that is what is sort of driving this narrative that rate cuts might happen at any point. But we need to understand the Fed mentality, which is that they have always been talking about making decisions by going from meeting to meeting and interpreting the data that is coming in that intermeeting period, right? So, but by and large, the way that the chairman has been talking, the way that the dot plots have appeared, and a lot of other things that have really shown us, looks like that rate cuts are on the card for this year. And when that happens, there is going to be a global sort of cycle that might be a little easier than the previous policies that we've had in the last few years. So, one thing that I would like to bring to everybody's attention is how fixed income actually works in cycles. So, if we, this is a chart that we've created with data from the RBI as well as LiveMint. So, LiveMint publishes a quilt every year that shows you how each of the sub asset classes or each asset class actually performs. So, we've looked at fixed income, which we've broadly categorized as corporate bonds, which are basically AAA rated and AA plus rated bonds. Then you have credit risk, which is anything outside of that. And then you have your government securities, which are your long-term sort of government obligations. And then you have your treasury bills, which are your 1 year or lower maturity papers. So if we look at this cycle, right, like how has this actually worked? And you'll see that by and large, because T-bills are just 1 year maturity, it kind of reflects the overall rate level that was there at that point in time. So your T-bills tend to be at the bottom of the table, but when you look at how this works, you'll see that your over each cycle. So if we look at the interest rate cycle first, you have from 2010 to 2014, you had interest rates rising. And in this time frame, interest rates went from roughly, let's say 5%, your repo went to about 8% in this time frame. So in this rising interest rate cycle, you had decent performance from corporate bonds, you had decent performance from credit risk, and in selective years, you had excellent performance from government securities. So when there's like a yield reduction, even when rates are rising, you can see outperformance from the government security space. But typically, in a rising interest rate scenario, you are going to see more uncertainty on the government security space rather than stability in that area, right? Then if we move to the next phase of interest rates, which is from 2015 to 2017, where you were actually in a falling interest rate cycle, your interest rates went from roughly about 8% to 6%. So that's a 2% change. And here again, you can see that much of the benefits from 2014 were already captured in 2014. So your GSET did not really perform that well in this space. But 15 was a good year. And you can see that if you've had outperformance in one period, you wouldn't necessarily have that sustain over a period of time, right? And then we have, of course, your credit risk also did well at this time because, again, you had wider spreads. Then you had the NBFC crisis, and you saw that credit basically went off the table. People were very opposed to that. Even corporate bonds suffered a little bit in 2018, but the security of I mean, the safety of having like a government security in your portfolio still did well. 2018 was a unique year in the sense that you had one in between year where interest rates went up, primarily because around this time the RBI had their inflation mandate come in, right? And you had the NPC meeting, and the inflation was getting slightly warmer than the committee liked, and then you had a couple of interest rate hikes. And then in 2019, you had some lower level of growth. So you started seeing some rate cuts between 2019, and then because of COVID, those rate cuts sort of accelerated, and you had 1 year of stability in 2021 where your rates really didn't change. And through 22 as well as 2023, we've seen rate hikes happen. 2023 also has been kind of like a 2021 year where you've not really seen too much change there. But you can see that when the cycle turned, again, your government security started performing well. During phases of uncertainty, credit did not do well. And then in the last few years, that is 21 to 23, when you've had relatively lower interest rates in the economy, you've really seen credit stand out. But when we come to 2024, I think there is opportunity in all these asset classes because your 1 year rates have actually moved up. If I look at a 1 year scenario, I could look at maybe 6.5 to 7% as a reasonable return. Your corporate bond spreads have started to gradually widen. And then you have your government securities where we can start preparing for the cycle to turn, even if we don't know exactly when that's going to happen. And credit yields are also fairly attractive today, right? We can go to the next slide. So I just want to do a quick poll, which is please type in your answers in the chat box. How do you think that each of these categories or overall, like what was the return that you could expect in fixed income if we look at the last 14-year data? Do you think the returns would have been in the space of 5 to 6% compounded, or 6 to 7%, or 7 to 8%, or 8 to 9? So you can just quickly just type out whatever you think it was. I do see a couple of questions here in the chat, and I will get to them at the end of the presentation if that's okay, sir. Okay. So we have a couple of answers for C, we have one answer for B. Okay, so if we, I think a lot of answers have come in for C, and I think that is a reasonable expectation. Harsini, we can move to the next slide, which is that if we look at each of these categories, right? So corporate bonds and credit risk are supposed to do better than your government securities because there is a spread that is there. So you have done, say, 8 to 9% on those securities. And on your government security side, you've done about 7.5. The T-bills, of course, given that they are short-term investments, plus the safest of the lot, really don't compound at a very aggressive rate. Now, the reason why we're looking at this data is because as an investor today, you need to really understand what is your long-term goal or what is your goal when you're allocating to fixed income, right? If you identify primarily as an equity investor, it's okay to look at a 4% return here because you're going to make your longer 10-12% return from equity because you're just temporarily protecting yourself from market volatility. If you are, on the other hand, a more serious fixed income investor and you are more conservative in nature, then you do need to look at a longer term idea, and there are many options for you. So depending on how much uh, you risk you want to take, depending on what you're comfortable with, or even the way in which you're going to invest, then you could look at either government securities today, or you could look at corporate bonds as well as credit risk. So now I just want to walk you through what we did through this cycle from 2013 to 2024. So in the rising interest rate scenario of 2013 to 2015, we started looking at government securities. We made some returns in 2024. So if you remember the chart, also you would have seen that 2024 was a good year for uh, government securities. We looked at tax-free bonds. This is not something that's really widely available in the market anymore today. As the cycle turned, we moved to high-quality NCDs. And then in 2018, when you had the NBFC crisis, we started looking at a fixed maturity plan. So we wanted to lock investors' returns, right? There was a lot of fear and panic in the fixed income market. You were able to get high quality, that is the best debt at 9% without any risk. So it was really not uh, like there was nothing to think about, right? There is no risk in making that kind of investment. And that served investors really well a couple of years down the line when they looked at their returns in 2020, 2021. So the time at which you make decisions in fixed income really matters, because unlike equity, you don't have that much scope for outperformance. That window can be very narrow. So as we move into 2020, we started looking at credit. So again, if you refresh your mind about what we talked about in the cycle. 2020 to 2024, like you've seen good performance in credit. Um, in the last year, that is 2023, we have only been looking at 1 year kind of investments in fixed income. And I think we have largely been right in selection, in product selection. And this is where investors can actually benefit from working with us. So, what can we expect out of 2024? We can expect more flows into debt. We can expect the yield curve to be a little bit more shaped. It was very flat in 2023. Uh, and now you're seeing some changes in how the yield curve is. And we can expect more spread in corporate debt, which basically means that returns in debt can improve if we are looking outside of government securities. But the best is yet to come as far as government securities are concerned, right? So this all of this data is from Business Line. Uh, so if we look at the 10-year GSEC, it has been pretty much flat. So there was bond index inclusion. That was the big news of 2023, that Indian government securities will now be part of global emerging market bond indices. And India is the world really doesn't have too many options, because ever since the Russia-Ukraine war happened, investments in Russian securities have been off the table. China, now investors are very scared about what is happening in China. So again, China is not getting any allocations. So that has really opened the door for India. It's not just China plus one in manufacturing and all of that. It is also China plus one in government securities. Second data point that we can look at is how um, much debt utilization is there in the government security. So if we look at 2020, uh, FPIs were basically buying around 43% of their capacity in Indian government bonds. In 2022 September, that is after the announcement of bond index, we were only at 17.5%. Today also we are only close to 18%. If we are at 18%, and at one point our highest has been 50% or 44%, right? We have a long way to go even to a midpoint. And as Indian government securities become more attractive to foreign investors, I think you will see this number go up. So there will be higher demand for uh, Indian government bonds. And when there is higher demand, there is more mark to market return that an investor can make. So this is just again another data point showing how much of the assets are actually in sovereign bonds. So you're seeing that things are picking up, and it is only going to go further up from here. And the last data point that we wanted to look at is how much money has come into debt in the last 6-7 months. So you can see that we've gone from roughly 1,000 crores to about 23,000 crores since September last year till now, right? So this data again is from Business Line. Yeah, we can go to the next slide, no problem. And from now, I'll hand over to Harsini.
So when you allocate your investments to fixed income, what are the different things that you need to know and assess before you make a decision? Firstly, fixed income instruments are often praised for the sense of predictability that they can give you because they offer regular returns at a fixed rate, right? So when you lock into an interest rate, you know exactly how much cash you'll be getting and when you'll be receiving it. This is unlike stocks where you will never be able to tell for sure that this is how much returns you'll be making in that particular period of time. This very predictable nature of fixed income makes it a perfect asset class for planning your finances. Whether you want to build an emergency fund for your liquidity needs, or save up for your child's education, or pay off your loans, fixed income investments can offer you that peace of mind that you need. Especially if you're heading to your years of retirement, then you should start considering building a reliable income source to cover your recurring bills like electricity or rent. Now, the most important part of allocating a portion of your investment to debt is that it will help preserve your wealth. This is true from an asset allocation standpoint as well. In times of volatility, this can help stabilize your portfolio and act as a cushion against market downturns. Moving on, let's talk about the opportunity that fixed income has for us in store. Now, both the FBI, Fed and the RBI have come out with strong statements saying that it's not yet time for the rate cuts to happen. Maybe we are close to where the cycle might take a turn, but we are not there yet. Now, our country is now at the peak of its interest rate cycle, which makes it an opportune time to lock into longer term debt. Now, why long term debt? When inflation starts to show signs of ease, central banks usually respond by lowering interest rates to stimulate more economic activity, right? So when interest rate starts to fall, existing bonds locked in at a higher coupon rate looks more valuable than the newly issued bonds that have lower coupon rate. So as a result, when investors flock to buy the existing bonds, this demand tends to drive up prices. In situations like this, long-term bonds tend to have more price appreciation than short-term bonds because they are more sensitive to interest rate changes, right? And the magnitude of returns will be relatively higher in credit bonds compared to high quality bonds because with higher risk comes higher returns. And also from a liquidity aspect, when you switch from equity to fixed income, it will give you enough leeway to go back to equities when you find equities more attractive to invest back in. This will not only provide you flexibility, but will enable you to optimize your return while you manage risk alongside. So now let's summarize the options that you need to keep in mind while making your fixed income allocations. Firstly, focusing on quality while investing in debt is very important because there are chances of losing your capital permanently. For example, if you invest rupee 100 in a fixed income bond, there are chances that it might go to zero because there is default risk that's coming along with it. But if you invest 100 rupee in the equity market, it can only grow in multiples, right? And like I mentioned in the previous slide, taking longer duration calls will help you grow your MTM appreciation. These investments are sure to be a little volatile, but this volatility can be managed through additional participation. So you should be able to come across volatility as an opportunity rather than a problem. So when there's volatility, you should be able to decide to scale up your investments rather than go into panic mode, right? So which is why it brings me to the point that layering your debt portfolios according to the financial plans that we talked about earlier is important. Only when you make a plan, only when you make a plan as per your requirements, will you be able to reap the best benefit out of the investments that you're making, right? So at Finesse, we actively offer a range of services to help you achieve your investment goals throughout your journey. Our team regularly posts monthly fixed income outlooks on our website, and we also conduct informative webinars to keep you updated on the latest market trends. We also provide personalized portfolio reviews to help you make informed decisions with your investments and optimize your investment performance and make your investment journey smooth. With that, let's open the floor for questions. We'd be more than happy to answer. You can use the chat box to type in questions.
ஸோ சாரி, நான் உங்க கமெண்ட் பார்க்கல. நீங்க ஏதாவது கேள்வி இருந்ததுன்னா நீங்க தமிழ்லயே கேட்டுடலாம். With US Fed and RBI set to reduce or lower the interest rate cycle, how can retail investors get higher yields? Or is it because of the reverse or inverse proportion of when rate cycle goes down, bond yields increase or like that? Please explain. Yes, sir. So basically we need to think about, okay, ஒரு bondல என்ன ஆகுறது? If I'm buying the bond for 100 rupees, right, and the rate is 7%, overall in market, everybody is getting 7% on their investment. Now, if the rate goes to 8%, my 100 rupee bond is not as attractive as a new 100 rupee bond which is coming at 8%. ஏன்னா அவங்களுக்கு 8% ரிட்டர்ன் வருது, எனக்கு 7% ரிட்டர்ன் தான் வருது. So automatically my price will go down. So if I want to sell in the market, I have to sell at a lower price so that that return is equal to 8% based on the price. So when the interest rate moves up, the bond price will reduce. When the interest rate moves down, the bond price will increase. So உங்களுக்கு return அதிகமா வரும் when the rates are coming down, right? Because in addition to what you are earning on the coupon, you will also get this additional return from the change in the bond price. But we can't take credit risk funds after all what we saw and experienced in 2018 by Franklin Saga when 5 of their funds faced huge issues and investors were taken for a ride. Never know when next skeleton will come from the closet. See, this is partly true. I think if you have some product research, ஒரு அளவுக்கு if you are paying attention அந்த ஃபண்ட்ல என்ன பண்றாங்க, என்ன மாதிரி ஸ்ட்ராட்டஜி இருக்கு, எவ்வளோ கிரெடிட் ரிஸ்க் எடுத்திருக்காங்க, எங்க கிரெடிட் ரிஸ்க் எடுத்திருக்காங்க, then I think there might be one or two very good investment options. So we need to keep that in mind that yes, things can happen. So actively, if you see what we had done, we had never recommended any schemes from Franklin Templeton on the debt side because we felt that the kind of risk that they were taking in that product. If a mutual fund, the biggest problem is that a client goes into the product, they can take out the money at any time. But the bond markets are little illiquid. So if there is stress, it's kind of like how SEBI is coming today and saying that we want to do a stress test on small cap portfolios where there might be very low float in certain stocks. அதே மாதிரி தான் credit risk. You will have some overlapping characteristics where it is difficult to get rid of this at the same price that you bought it at. It can still be a good investment, it can still be a good company, it can still be a good bond, but there has to be somebody who's willing to buy it from you at a fair price. அதனால தான் you had this problem in Templeton. They have returned the money, but it was not the mutual fund was not the right product. Either if they had done in an AIF or an FMP, maybe that pressure would not have been there to shut down the schemes, right? We don't know, of course, but you need to keep in mind that with the right product research, you might find something even in that category. We just need to be careful. So I'm just going to the next question, which is, could you explain what would give a better return, corporate bond fund or short-term debt fund? So I think, see, short-term debt can give a good return when you're at a higher interest rate and the rate is increasing because automatically that portfolio will adjust and reset as the rate is moving into a higher yield. Now, corporate bond can give you good returns through the entire cycle because they can change the duration to match the interest rate cycle and you can get a good return from that. Now, other thing is in short term, generally there is no uh, sort of restriction on the quality of the portfolio. Short term fund la double A paper vaangala, triple A paper vaangala. It can be pure triple A fund. You can have a credit kind of short term fund. ரெண்டுமே இருக்கலாம், right? Um, so you need to see each fund and judge on that merit and only decide. But corporate bond fund la முக்காவாசி credit risk னு இருக்காது, because mandate is itself that you have to do double A plus and above for 80% of the portfolio, I think. So very little scope for credit risk. Most AMCs that we have studied are keeping pure AAA only in the corporate debt. So cycle we have to assess those three factors, right? Credit nalla perform panuma, interest rate nalla perform panuma, illati what is the situation. Then you can judge in this year whether this will be better or that will be better. By and large, I think corporate bond you can invest through the cycle. It is that kind of open-ended product risk without taking too much risk, and having that benefit of modifying the duration of the portfolio. You will get that opportunity. Sure. So we can talk about Franklin Templeton. Uh, so Franklin Templeton, what happened was they were running. So generally, we need to understand the bond market, right? It is an illiquid space. It is not like the equity market where daily stocks are getting traded. Typically, people who buy bonds tend to hold them until they mature. Uh, but when you have a product like a mutual fund, there can be some level of trading that and churn that happens on a more regular basis. So, but that liquidity, the most liquid part of the market is the government security segment, because that has a lot of institutional participation. Then you'll have your AAA corporate bonds, and below that, the liquidity is actually very, very limited. So in Templeton, what they were doing is they were buying bonds which are not very liquid. And as a mutual fund, you have an obligation or a responsibility to fund investor redemptions, right? So and you have to market your bonds on a day-to-day basis, which means that today, if I try to trade a bond, what is the price? Based on that, I have to publish my NAV. So what was happening was when the COVID crisis happened, for a while there had been some stress in those portfolios, but more and more investors were starting to redeem their funds. And when you redeem, you have to actually realize these losses, right? It's not like a notional loss. So to prevent excess redemption, and also what was tending to happen is the investor who redeemed their portfolio got their money, but the investors who stayed invested were getting stuck and taking those mark to market hits and the realized loss. So to make it more equitable, I think the regulatory response as well as Templeton's response was to shut down those schemes, to stop the redemptions, and to by and large, they felt that there was no default risk in the investments that they had made. It was not that these companies had gone bust and they were not repaying. It was just that investors wanted the money back at a very quick pace and they were not able to deliver on that. So over a period of time, they were able to collect the interest as well as the principal payments from these from these bonds, and then they were able to repay investors. But again, from an investor experience perspective, you go into a fund expecting that you can take your money out at any point. So you need to be careful about how risks are managed within the products that you are choosing. And that is a conversation that you should have with your distributor or advisor, whoever you are working with. Yes, sir. Of course, this will be available in YouTube. If you have any questions, please ask us in the chat box. We'll be happy to answer, even if we have covered it in the earlier part. Correct. So credit rating is only one element of the discussion, right? There is so much that is there in a bond. So if you look at credit rating, that gives us some idea, but basically the credit rating agencies will only re-rate a company when an event occurs or if the company comes to borrow again in the market. So in between, if there is some update, etc., it's not necessary that there will be a proactive update on the credit rating agency side. The second thing is you can actually go and look at our content from 2018, 2017, where we had strictly told investors even before the NBFC crisis happened, we were only focusing on quality. We did not look at any credit. We avoided ILNFS, we avoided DHFL, we avoided all of these things because we were very focused on understanding the corporate structure. These are all pretty complicated. In DHFL case, we can share the blog link also with you after the webinar. But we had published some things on what was happening, at what point we started communicating with investors. There were a few funds that had DHFL. We highlighted all of these risks because we need to be on top of this game, right? We need to understand what is happening in the market. Uh, Regarding your services, could you please elaborate on portfolio analysis service? Something like, will you analyze my current equity portfolio and share your views? I think you can, if you are a client, you can reach out to your point of contact and they will be able to assist you on what can actually be done. Uh, if you're not a client, probably we will get in touch with you after the webinar and we can see what you are looking for and whether it will be possible. So this will be a one-on-one conversation to let you know like what we are doing and whether what is the scope of service. With inclusion of India in the bond index, will it make the borrowing cheaper for India? If yes, then how can we expect the debt investment to grow? So if India is included in the bond index, again, something becoming cheaper is based on multiple things, right? One of the key things is supply demand. So if the demand goes up and the supply is stable, then your borrowing cost will become cheaper, right? Because you will just end up paying less. If it's the other way around, that is your demand goes up, but your supply also goes up, then you can remain at the same borrowing cost as well. You'll just have a higher amount of debt. So we need to see how that supply demand dynamic is actually working before we make a judgment. But for now, the way that we are seeing consistent fiscal consolidation, which means supply is going to be stable or reducing, and you're seeing more and more foreign interest, but there are many operational issues. So the reason we showed you those charts from business line is basically because the yield has not at all moved, right? In spite of all the good news, the yield is staying at the same level, which means that the markets are factoring in some other risk or some other requirement, and there are some operational roadblocks also in foreign investors buying Indian government debt. Uh, so that could also be one of the reasons why it is more expensive. So T-bill is basically a treasury bill. It can be anything with less than 365 days maturity issued by the government. GSEC generally you mean something that is longer term. So anything outside of the T-bill will be considered to be like a government security bond. Typically, you'll have 10-year, 11-year, 12-year, 15, 20, 25, 30. They are much longer term government securities. These things, as they start maturing, might have like lower each year. Like this year, if the government issues a 10-year bond, next year it will be a 9-year bond, right? So you can have different parts of the yield curve as time moves. Under fixed income, we do work with bonds, we work with corporate deposits, mutual funds, and we also have sometimes, if there is a requirement, we can study other products like AIFs as well for investors. Correct. So for T-bills, your duration will be lower. It will be close to the actual maturity. For government securities, typically, if you have a 10-year bond, the duration will be less than 10 years. It will not be exactly 10 years because you have the interest payment also that is coming in twice a year. First of all, why should we take high risk for high returns in debt? As basically, debt funds are the most are mostly for safety alone, right? More so for emergency purposes only. And why should we use debt funds like credit risk, etc., to get a little bit extra percent yield? Uh, so it is actually more of a cyclical decision than this thing, right? If you want an allocation to fixed income and you have a certain return in mind and the product is working for you from the cyclical perspective, you can look at credit risk. But by and large, our philosophy very much aligns with what you're saying. We don't think that it's worth taking extra risk in debt because it's not like equity. If I make a bad decision in debt, my investment can go from 100 to 0, right? And but if I make a really good decision, I can make maybe 7 to 10%. That is the maximum sort of return range that you can see. Uh, Unlike equity, where let's say you pick 5 stocks, one doesn't work out at all, the other four can compensate for that. In debt, you don't have that compensation effect, right? Somebody who's not comfortable with taking risk in debt, that is the right approach, because there is the risk of capital loss in debt which you don't really have in other asset classes. So if I buy a property or if I buy gold, right, I am not going to lose 100% of my value. If something goes in the worst case scenario also, I'm not going to lose 100%. I will have some residual value. In debt, sometimes that takes a long time for you to get even that basic residual value. I think it should be uploaded on the YouTube channel either today or tomorrow, sir. We can send you the link. So whether it comes to bonds or bond funds, I think that depends largely on what you want to achieve. So if you want a higher yield, then bond will work out better, but that comes with no liquidity. So you have to be willing to hold to maturity whatever bonds you're buying. If you want a more diversified portfolio, that is, you don't want any risk with one or two bonds, then the fund works out better. I think largely for most investors, there is some efficiency in owning the bond fund rather than the bond itself. But selectively, if you're getting a good yield bond plus there is some safety, I think then you can look at that. Thank you, sir. We're so happy that we were able to answer your questions. If you have anything else, please reach out to us. Can we use mix of precious metals and long-term duration bonds at this juncture, or only long-term? You can use a mix, definitely. I think gold performance has happened, but it's not the end of the this thing. We have been talking about gold for a few years now, and you will hear us also on this entire concept or usage of debt funds needs relook despite me being a long-term investor, because debt is in fact more higher risk than even equity. Yes, that is correct, sir. Because I think if you're looking at debt from a pure safety perspective, you get that predictability. But if you're looking to achieve anything else, there are higher risks than in equity. So it is better to be more conservative. So credit rating, it's basically because they are borrowing at a higher rate, they are coming to the market and taking a higher rate of interest only because uh, they don't have that strength in balance sheet or they don't have that strength in execution. And because they don't have these fundamental characteristics, rating can be lower, right? Yes, InvITs are a good option, but you need to do the yield calculation on your own, because typically in the InvIT there is a repayment of principal structure also. And again, always you need to assess the risk of these things, because the InvITs are basically infrastructure projects. So the execution needs to be good on those. Only then you will have the cash flows. RBI governor said that market is ahead in expectation regards to rate cut. What is your view? By and large, I think the RBI governor is right, and they would know better than me, right? If they are saying that the market is ahead, They are the ones who have better insight as to whether they are going to cut rates or not. I frankly don't know, and I can't. I mean, I can guess that it's not going to happen anytime soon because you still have good growth. You still have. I mean, it can happen at any time, but what I feel is for the next meeting at least, because inflation is under like above the target of 4%, but within the band of 6%, I mean 2 to 6%, plus you have good growth. So there is no immediate need to cut the rate, right? There is no urgency in cutting the rate because you're not seeing growth slowdown, you're not seeing any of those problems that would require a rate cut. And if the, from what I'm understanding, the way Fed and RBI are talking, as long as everything is okay, they are not going to change what they are doing. They're only going to change when they feel that an issue is coming up or that they need to address some specific problem, whether it is inflation or recession or whatever. Thank you, sir. We have we have a few more questions. So Indian government has released 50-year bonds. Can retail invest in those bonds? I think RBI has a direct platform for retail investors to buy government securities. So yes, I think you should be able to invest in those bonds if you want to. But just be aware that if you are buying any bond, whether it is government security or otherwise, for retail investor, there needs to be some liquidity for you to be able to exit. And typically, that is not there. I'm not very well versed with the bond platform. So please check that before you make the investment alone. That's all I would say. Is it wise to invest in debt funds now, considering the removal of indexation benefits? Does it make sense to invest in multi-asset funds instead, which will have debt component and taxation will be of equity? See, I think we need to separate or understand why we are making a particular investment in the first place. If your primary objective is tax efficiency, then yes, you can look at, say, arbitrage, you can look at multi asset, or you can look at some of the hybrid funds where you're getting that indexation benefit taxation, right? You have one category that has that, you have one category that gets equity taxation. But if that is not the objective, if you're not making an investment purely out of a tax decision, and you're making a decision because now you have made money in one asset class, you want to park it in another asset class, you want that flexibility to move out from debt into equity, or you want to stay in debt because you have a short term commitment, or you want to stay in debt because you're a conservative investor, then I still think that you should make that decision, right? And yes, indexation is gone, but let's say you are doing an SIP or something in debt funds, right? You are not going to pay tax until you redeem. And if this is a longer term investment, you can plan it in such a way that you're able to invest in one fund or two funds that can form part of your retirement corpus, that can form part of your longer term allocation. And tax is something we have to pay. Tomorrow, if they come and say that they're going to tax equity at a higher rate, we cannot completely move out of that asset class, right? Um, but we do understand that there is this concern that if I'm in my 30% tax bracket, then automatically the return is very unattractive. So for short term options, I think there are better alternatives outside of debt funds. But from a longer term allocation perspective, I don't think you should shy away from this. And now I think you're getting a lot of high yield bonds, right? So someone in the 30% tax bracket can also look at bonds instead of say a debt fund where your return will be around 7.5%. You can look at something that might give you 1-2% more than that. Views on rate in WIT as an asset class. Rates are actually, I don't think that's a very deep market in India right now. And the structure of the rate itself is that it is an income distribution product, right? That is, whatever income that the real estate investment trust gets, they mandatorily have to distribute most of it to the investors on a regular basis. So that's not really like a growth oriented product. So for an investor who's looking to grow or see their wealth compound over a period of time, I don't think the rate market in India is structured for that today. InvITs are good. So, like I said, we have to look at execution capability, because after all, this is like an infrastructure project that is delivering these cash flows. You need to also calculate the yield, because over a period of time, the InvIT document will state when the principal is coming back. So that will actually modify your overall return. So if you keep both of these factors in mind, I think you can make a well-informed decision on that. You're welcome, sir. Tarun, do we have any more questions from YouTube?
That's it, Sam.
Okay, great. If there are any other questions, we still have 5 minutes. So Harshini and I will be here. We can answer any questions that you have. But once again, thank you for joining us. Thank you for asking all of these questions and making us think. And we'd be very excited to have you on board and work with you. So if there's anything that we can do for you, I think, Harshini, you can just put our contact details so that everybody in the webinar can see or get in touch with us if there's anything. Uh, like Harshini said, on a monthly basis, we do these webinars. We also um, we also publish a blog, and you can go and look at what we've written in the past also. So we've avoided a lot of the big issues in fixed income markets by just being a little careful and conservative in how we do things. And our track record also in terms of ideas has been pretty good. So if there's uh, anything that you need, we can definitely help you on the fixed income as well as the equity side. On the Milestones to Wealth, we have a few other platforms as well. So on Milestones to Wealth, every week there's a webinar. We're always discussing something interesting. On the PMS side also, we have 4 different products and a very capable team that is handling that. So there's, I think today, Tarun, there's a corporate India webinar, right? You can just go to the next slide, Harshini. It has the contact details.
Hey, Sam, there's one more question. I'll just post it on the
Sure.
chat board.
This is more of a personal question, because it depends on your risk appetite. It depends on what kind of equity you have, as well as what kind of goals you have, right? So if you have short-term financial commitments, 100% there needs to be some shift from debt into equity to protect those investments and meet those commitments. If on the other hand, you don't have anything in the short term, but a lot of your returns have come from riskier parts in the equity market, then you would need to profit book in those segments. You might need to get fully out of some investments and then restructure your equity. And the restructuring of equity can happen over 6 months or so. It is not something that will happen immediately. So I think that it's very difficult with this limited information for me to tell you what percentage of your assets should be moved to debt. And there is no, there is no one answer, right? Like people will tell you for your age, this should be your allocation in equity and in debt. It really doesn't work that way. What we have realized is that this is a very serious conversation that you should have with your advisor or your distributor and understand what actually is the best option for you. All right. I think that's all in terms of questions. Thank you for coming in. We'll see you next month on Finesse. But there are many other things happening in the interim. So please do join us for one of our other webinars. We'll be delighted to have you there. Thank you.
Thank you for joining. Have a good weekend.
Good day, sir.